This is Chad Toyne with your Tuesday, March 3 Market Minute from Trader PhD Ag Marketing. In the grains, we've had 4 overhead price targets get hit in the grains lately. Friday saw targets get hit in corn, beans, and Minneapolis wheat, which triggers sell signals, and we just had our new crop Dees corn target get hit at $4.73 in the overnight. And right now it's trading about 3 cents lower than that. So let's get you these new price targets here right at the top of the broadcast so they're quick and easy to re-listen on a callback. Corn, old crop 25, new target May at $4.68. New crop 26, new target December at $4.91. Soybeans, old crop 25, new target May at $12.53. New crop 26 stays November at $11.44. No change in Chicago SRW wheat. Old crop 25 stays May at $6.10. New crop 26 stays July at $6.33. No change in KCHRW wheat. Old crop 25 stays May at $6.26. New crop 26 stays July at $6.29. Minneapolis HRS wheat. Old crop 25 stays May at $6.33. New crop 26 new target September at $6.78. Cotton, old crop 25 now, May at $67.91. New crop 26 now, December at $77.06. Seems like old news, but it was just this weekend. Israel and the United States had over 1,000 strikes on Iran. The supreme leader is dead. 10 Iranian ships have been sunk, and what has to be a highly fractured leadership leaves Iran to have counterstrikes, not only against Israel and U.S. bases in the region, but Iran has been doing strikes on a number of other neighboring countries that seemingly have no horse in the race. Whereas yesterday seemed like things were shockingly under control, now it's starting to worry investors that the Middle East conflict is spreading. Iran has declared that the Strait of Hormuz is closed. It's unclear if it's actually closed by force or if the physicality of it all is a moot point. Insurance companies have pulled coverage for ships that travel there, so they just don't go through. So after crude gapped open way higher on Monday morning and later paired much of their gains, crude is back up today, and that has grains surging today in early morning trading. You saw our Dees corn target get hit, and now grains have paired their gains as well. Stocks are selling off today, but gold is down $200 an ounce. If gold can't rally in this environment, it makes you wonder if gold has much upside potential left. Heating oil is blowing the lid off the charts. Why is heating oil exploding in percentage terms so much more than crude oil? It's a refinery product that we export, and the world is clamoring for it much more than crude itself. We gave you guys buy signals for heating oil to book some diesel back on both December 23 and on January 9, right around the time Venezuela was attracting the U.S. Navy buildup, and we were near 6-month lows. On what's now the April heating oil contract, the average of those 2 dates was a price of $2.08 a gallon. It surged 51 cents a gallon to $2.59 just before the weekend. Monday alone saw heating oil explode 30 cents higher, and now here today we're another 36 cents higher. We are now looking at $3.25 heating oil, not $2.08. We hope we saved you $1 a gallon. And now folks are worried about fertilizer. So much fertilizer, like anhydrous, comes out of countries that export it through the Strait of Hormuz. And it's not just the price of fertilizer. Some folks are having a tough time even getting a price for it. Also this morning, news is that Israel made a new strike in Iran targeting an Iranian leadership meeting to select a new supreme leader. 49 people were killed in a leadership meeting over the weekend that started the strikes on Iran, and now there's been another strike here this morning on a new meeting on succession. So, what's likely to happen? It appears that the United States is going to continue to make strikes on Iran until they are neutralized, either kinetically or diplomatically. Venezuela was quick, simple, and easy, and we are only 4 days into Iran. I'd imagine after a couple of weeks, all of the big guns are going to be wiped out, and little skirmishes will be all that's left. The U.S. Navy will secure shipping, and some normalcy will continue. But what we don't know is that these little sticks and stones are going to be left for some months to come, and little fractions keep making a fuss. It's one thing to destroy an army, but it's another thing to bring the whole nation of people together. Will a drone or two, here or there, be launched to strike a ship every other week for the foreseeable future? Can the region be brought under control enough so the markets don't suffer disruption? All of that remains to be seen, and until then, we have to deal with the uncertainty. Meanwhile, just stay on top of your price targets, identify and hedge some of your downside risk, and basically stay disciplined. I expect corn to chop sideways to higher. Surging crude oil is going to support ethanol. We export ethanol like we export heating oil. Soybeans are also awaiting biofuel obligations after the EPA submitted their report to the White House. Wheat is in play with shipping getting caught up in the Middle East, deteriorating crop conditions in France, drought in the U.S., and the funds getting caught short in a surging market. Cotton has fallen back hard in the past few days, and I think it's going to stay largely range-bound. The cattle markets have reversed after a nasty Monday morning open. I think both fats and feeders are carving out a new trading range, and we've likely put in a low of that range. A bounce back higher might prompt us to price some cattle, so stay tuned. Hogs are sagging, but they haven't broken lower yet. I'm expecting some sideways to lower action for the short term. That's it for today. I'm Chad Toyne, and this has been Trader PhD. Past performance is not indicative of future results. Futures trading involves substantial risk and is not suitable for all investors.